Hey guys, welcome back to another episode of our webinar series. It's good to have everybody here back for webinar number 3 of our free course for the Crypto Dojo Discord group and the Crypto Paradox Facebook community. If you are watching this on a recording, you can always jump across into a Discord community and you can read the chat that was running alongside with this, because we don't use the chat in the actual chat box. And there's also going to be the recordings that will get put up in this section here. And then don't forget to post your homework in this session. And then also there is the dojo in here as well, where you can post your P&L statements, and you're going to running to win $100 from Bing X, which is pretty handy. So yeah, if you're on the free chat, yes, so remember we're recording right now already. If you're on the free chat and you have any questions, just let us know, and maybe Romps or Critty will try and get my attention and we can go from there. This is a little bit more of a complicated subject because obviously we're doing economics, right? So it's a little bit more theory involved, but hopefully it helps you guys understand just how to read the economy a little bit better and macro conditions and things like that. And obviously right now, we're on the brink of collapse, or brink of, the next bailout for banks, which is, a part of why Satoshi originally, I should say, not eventually, created Bitcoin. And his famous title of his first post was Chancellor on the second bailout for banks. And basically we're on Chancellor on the third bailout for banks right now. And that happened over the weekend. So I think it's a perfect opportunity to cover off economics today. And then we're going to go into, he put it in the Genesis block. And then, we're going to do some trading psychology after that. We're also going to get Romps up on stage as well, and he's going to take us through some trading psychology stuff he's been working on as well for you guys. And then also just a few things on, trading psychology around the chart colors and things like that to help you guys just feel a little bit more at ease when you're looking at the charts. All right, let's keep moving. So first up, economics. How does monetary policy work? Right, so the dual mandate for the Federal Reserve, I think, is a really important subject to understand. And basically, since 1997, the maximum employment and stable prices and moderating long-term interest rates. So that is the mandate that the Federal Reserve has. So they call it the dual mandate because it's, they have to balance between maximum, controlling monetary policy to focus on maximum employment, which we're pretty much at the moment. We're going to look at that a little bit later. I'm going to show you some charts how you can get up the unemployment rate and stuff like that. We have some amazing tools now in TradingView, which you should be able to use. Any respectable trader should be able to understand how to use those types of tools that TradingView has made available to us. All the data and stuff like that from the Federal Reserve is really handy. So we're going to go through that as well. But back on track. So maximum employment and then stable prices. So it's basically the unemployment rate versus inflation, right? And they're trying to constantly balance that. And when one gets too out of hand, they have to pull on their economic triggers and tools that they have, which is basically raising lower interest rates. And then also now they have quantitative easing and quantitative tightening as well, which is putting more money into the economy or taking it out of the economy. And that's pretty much their main focus, right? And those are their tools that they have. So the Fed has an obligation to keep inflation between 2 to 3% on a long-term average basis, right? And they also have a mandate to keep unemployment as low as possible. That's why I call it maximum employment, right? So at the moment, because inflation is out of control, it's still currently at 6.4% for CPI, and core is a little bit lower. We do have CPI tonight, so we're going to cover off a little bit about that also. But basically, CPI has been out of control, and so their focus at the moment is on getting inflation back down, which is why they're raising interest rates, right? And then eventually what it's about to switch to, and this is probably a very important point, so make sure you're paying attention for this, guys. It's going to flick back from the one side of the dual mandate to the other side of the dual mandate. So at the moment, they're focused on stable prices, right? The next thing is going to end up being they're going to have to switch to focusing on maximum employment. So eventually CPI is going to start to come back down, and we're going to start to head towards that 2 to 3% range. I think as soon as we start to get under 4% for CPI, unemployment is going to start to raise, because that's the sort of cycle that it goes through. Generally CPI tops, right? Then it starts to have its pullback. And then as CPI is coming back down, it gets to a certain level that's decently low. The Fed finally pivots, which we could be about to see this month at FOMC on the 22nd, or potentially, next month if they do still raise 25 basis points. We'll talk about that later. And so basically, what we're looking at is they might be forced to switch back to focusing on that unemployment, as unemployment usually is the next thing to start to raise after the Fed stops, flips back to their pivot, right? So they've been raising at the moment. CPI is going up. Once CPI starts to come down, they stop raising, they pivot, and then the issue becomes unemployment. And it's important to understand the reasons behind why this happens, guys. It's not just numbers and lines going up and down on the chart, right? The reason why unemployment starts to take off, and the reason why they stop raising interest rates and they have the Fed pivot, is because the economy actually is starting to break down. And we're in that moment right now where the economy is actually starting to break. And that is because it's the financial system. The economy isn't in that bad of a shape. Earnings are starting to take a little bit of a hit lately. But after, this big scare that everybody's happening, all my friends in the US are messaging me man, this is crazy. Do I need to move money out of my bank account and all this sort of stuff? I put up a post on Twitter the other day. I'm like, people are worried about having to take money out of their bank account, hold it in cash or hold it in silver coins and stuff like that. What do you think that's going to do to their consumer spending psychology moving forward, right? So most likely what's going to happen is that we're going to start to see all this big fear kicking in about all the banks going insolvent and needing bailouts and stuff like that. And that can easily start to kick and move across into consumers having more fear and spending less, focusing on saving more. And then you start to see the hospitality industry and stuff like that, they start to get hit. And then you start to see that come across in earnings and more layoffs, and unemployment starts to go up finally. And then the next shift after that, now we're focusing on maximum employment, right? So at the moment, we're focused on stable prices. Next, everything I just said starts to happen. Then the focus becomes maximum employment. And then we have to switch from QT into QE. So QT is taking money out of the economy, right? Lowering the balance sheet. And we've got a really cool tool. I'm going to show you guys how you can read that later. And then QE, which is injecting more money back into the economy, which helps risk assets go up, right? And so that's sort of the pivot that's going on at the moment, because markets are forward looking. That's why things like Bitcoin pumped really hard over the weekend when basically the Fed came out and said they're going to do some form of QE to save these banks, right? All right, so let's get into it a little bit deeper. The Fed has limited tools. So QT, which is quantitative tightening, is basically when the market gets too hot, inflation picks up, the Federal Reserve will increase interest rates and reduce the balance sheet, right? So the balance sheet is basically a running total that they have of how much money they've injected into the economy. By buying government bonds, right? So they buy the government bonds, that gives money to the government, then they can put it out into stimulus packages and stuff like that, right? Yeah, this pulls USD. So when they're doing the other way, they're doing QT, they're actually removing money, they're taking money off the banks basically. So then they have less money to lend to people. So this pulls out USD from the global economy through the banking system. This creates a bearish market conditions as people sell risk assets, as banks now have access to less capital. They give out less loans and financial conditions begin to tighten. The economy slows with less new projects starting, like construction and stuff like that. And then this leads to less jobs being created and unemployment starts to rise, right? I'll give you no idea, basically dropped a pretty good sequence of events, which I can share with you guys. Right, basically said sequence of events goes like this. 1, rates keep rising, recession occurs, unemployment, employers cut jobs, unemployment rises, household spending drops, inflation falls, rates start to fall, right? It's a pretty good summary. It's weird that I'm all jacked up for macroeconomics. I know. It's exciting times at the moment for macro people. All right. So then QE. QE is quantitative easing, right? And this is when unemployment is rising and bond markets are crashing, right? Or sorry, I should say, and markets are crashing. When unemployment is rising and markets are crashing, the Federal Reserve can create US dollars, right? They literally just print it on a computer screen and then they send it across and they buy US treasuries, government bonds, and this helps bring down interest rates in the credit markets, which makes liquidity and capital more accessible for the banks at lower rates. So then they can lend to more people and businesses at lower rates, which means more new homes get built, more consumer spending, more projects get started. This boosts employment and stimulates economic growth, right? So basically everything that they were doing in COVID is a really good example of this, right? This also gives extra funding for the government for stimulus and infrastructure packages, right? So building roads, hospitals, schools, all that sort of stuff. Okay, so the Fed funds rate is an important thing to understand, right? And this is the rate that they always talk about, right? And the peak Fed, they're talking about the peak rate for this cycle until the Federal Reserve reverses its rates and starts to cut rates, right? So the Fed funds rate is the interest rate at which banks and other depository institutions lend money to each other. So depository institutions are basically types of banks, right? Credit unions and stuff like that. Lend money to each other, usually an overnight basis. And that's why they call it the overnight rate. The law requires banks to keep a certain percentage of their customers' money on reserve, where the banks earn no interest on it. Usually it's about 10%, but it can depend on the type of bank or credit union. Consequently, banks try to stay as close to the reserve limit as possible without going under it, right? Because they want to lend out as much money as possible, because the more money they lend out, the more money they have, right? Lending money back and forth to maintain a proper level. Right. I'm just going to bring across the chat again because Augie, no idea, drop the rest of it. So that's basically the QT part. And this is more about the QE part. People can't pay mortgages due to unemployment. Families fall apart. Suicide rates increase. The rich get richer. I thought you were going to finish off the QE part, but anyway, it doesn't matter. The rich get richer part is basically when the government starts to print all the capital and assets go through the roof, right? And, we get to take part in that and be part of the rich getting richer when QE comes back into it, because if you manage to get through this bear market cycle with having spare capital on the side, which in crypto has been extremely difficult because so many institutions that usually hold our capital have unfortunately gone under and stolen our money, like FTX and Celsius and Luna and stuff like that. But if you manage to avoid all of those, you're in a really good position to, potentially buy the capitulation and maximum point of fear coming up, right? And we're going to go through market cycles in the next session, so don't worry too much about that. We're going to go through maximum point of fear, which is usually the maximum point of financial return, right? But in short, guys, QE equals pumps, QT equals bear market, right? And pretty much everybody missed this at the top of the cycle in November 2021, right? It was one of the main reasons why I actually sold the top. So you can use this stuff to really help give you a massive edge over the rest of the market, right? And some of the biggest players in the game, like they should say 3AC, not 2AC, Three Arrows Capital, Celsius, and some of the other large hedge funds in the crypto space, they all missed this and got wrecked. And a lot of even really good traders that I'm friends with and talk to on Facebook and on Twitter, I should have said, they missed the top and they're all looking for much higher prices, 150K, 200K, 400K, etc. And to be honest, I was looking for much higher prices as well until, it became obvious that the Federal Reserve was going to switch, right? So, a lot of people have been asking me about exit strategies, right? Exit strategies was one of the number one requests that we had in the forms that everyone filled out for the course, right? And the reason is for that everybody basically, it's easy to buy in crypto because markets trend, especially in the bull market, it trends for almost a year and a half, right? So you're in a year and a half to buy. If you bought any time in that year and a half and held for a little bit, you're probably going to be up, right? Especially if you buy altcoins at the right time and stuff like that, but nobody gets out in time. So I thought this was one of the easiest tops that we're ever going to get a top signal for, right? And because of the high time frame signals that we got, right, I hate it when auto switches on, but basically we had our weekly pin bar rejections, right? This was a bit of a signal, but then we rejected that and pushed higher, right? And then we got this pin bar through here. And then, we've been talking about the shooting star reversal setup, right? And then also if it is a shooting star reversal that closes as a bearish or bullish engulfing, that gives us a much higher percentage chance that this is going to continue in that direction of the reversal pattern, right? So this is a bullish engulfing on the weekly back here, right? Bullish engulfing at the bottom of the channel, at the bottom of the channel, and also at the bottom of the end of the accumulation range, I should say, right? Bullish engulfing, right? Now we have big, strong, bearish engulfing on the weekly in combination with a shooting star reversal. And what happens? We go into a downtrend from that point there, right? So whenever this happens, you need to take note. Same thing happened back here. Excuse me. Shooting star reversal, right? Bearish engulfing, shooting star reversal, and what happens, right? So especially on the weekly time frame, need to take note of that. Here was another example that didn't get the follow through. Bearish engulfing, shooting star reversal, but what happens? We move literally into a morning star reversal, right? Morning star reversal straight afterwards, which was what? A bullish engulfing morning star reversal, and then we continue to pump to upside. Right. So just learning that simple candlestick trick can help you make a lot of money. At least gives you the high time frame trend, right? So even if you were long somewhere in here, right, you get that confirmation that weekly closes above there and also above this level. That gives you confirmation we're going to continue to move to the upside, right? It's the same as what we were talking about with order blocks last week, right? But other things, obviously coming back below and closing back below this level through here, and then it being the end of the year as well. So like being in Q4, like you really need to be pumping in Q4, and we're in the middle of November and it was just looking really weak. And the multiple swing failure patterns with the swing failure pattern here, and then the monthly time frame, right? And then if we look at the monthly time frame, right, we had a massive monthly swing failure pattern here at the highs. And then this was also set up for a shooting star reversal on the monthly time frame as well, right? So same thing through here, right? That shooting star reversal type setup. And yeah, basically that was the combination of what the charts were telling me, and then also the combination of the Federal Reserve coming out and basically saying that they're going to have to start to implement QT later on in the year, and the markets instantly reacted, right? Because the markets are forward looking. So actually the day that we ended up topping, this day here, the 10th of November, Wednesday, the 10th of November, this was actually a day where there was a CPI reading. It was the first CPI reading above 6%. It was 6.1%. Now, why is that important? Because today, we are looking at the first CPI reading that is expected to come under the CPI reading that put the top in the market, right? So this day, CPI reading was 6.1%. At the moment, let me just get it up. Right, at the moment, our CPI forecasted is 6%, right? So I don't know, maybe the first time we get underneath the CPI reading that put the top in the market, maybe that potentially is going to be the trigger that we need to break out of this accumulation range that we've been in for almost, I don't know how long has this been? It's been 270 something days, right? I don't know how much of a year that is, but it's going to be close to 10 months or something, right? So it's a long goddamn time we've been in that accumulation range. So basically, the combination of everything, understanding macroeconomics and stuff like that, and that the Federal Reserve, as soon as the inflation came in high, I understood that the Federal Reserve was going to have to switch from being in a QE phase, right, which was all the way from the bottom of the COVID nuke all the way back down here, right? They basically came out and said, we're going to give $2 trillion to BlackRock to support the market, right? And from then I knew 100% market was just going to be up only, right? And a lot of people got caught in this spot down here where we had basically almost a head and shoulders setup, right? And then we looked at that last week with the head and shoulders failure type setup. There was an even better one on the SPX back here. And so many people got wrecked by this because everyone was like, oh, head and shoulders setup, right? Head and shoulders is going to roll back down and we're going to have to at least double bottom. There's no way there's going to be a V-shaped reversal. But I was looking at this and I was like, okay, yeah, there's a bearish setup, but I understand usually at the start of a new uptrend, a lot of the time we do get a pattern failure, a head and shoulders pattern. So I was looking for that. Plus I had the edge of understanding the macroeconomic situation, that we're moving into a really strong QE period, and the Fed had just given all this money to BlackRock, and most likely the market was just going to flip this into a head and shoulders failure and pump, and everybody was going to get caught up offside. So say you can sort of like blend the two of reading the chart and understanding your setups, but then also having a little bit of an edge in the bias of understanding the macroeconomics part of it. To give you that extra edge over everybody else, the understanding that we are in QE at that stage, we were most likely going to continue to push. And then when the market was obvious that we were going to have to flip to QE because inflation was getting too high and interest rates were going to have to start going up, right? A lot of people got caught in the same thing. They were expecting the trend to continue because they were just looking at the chart, right? And instead, they broke out here and it was obvious that we're in a distribution pattern through here, right? Obviously, that was in a distribution pattern with a UTAD up thrust after distribution through here, which caught a lot of people. And then also the same thing happened in Bitcoin. People were expecting us to continue to push higher. I've lost my chart. People were expecting us to push higher after coming back down into these levels here, and they just got wrecked because it was such an obvious signal as well. So hopefully, this will help give you guys a little bit of an edge so you can understand and read it like that for the next time that we switch again as well. But I think most people are aware about the QE part because everyone sees the money printers and stuff like that. But when it flips the other way, it can be a little bit tougher to catch, right? All right, so let's keep moving forward. So economics, almost every top and bottom of this bear market cycle has been formed around a CPI on the SPX and also on Bitcoin. So we just looked at the very top on BTC, right, which was this day in here when we hit 69K. That was a CPI date when the market came out at 6.1%. And then not the exact bottom, but very close to the bottom. This day here, which is 1 year later, actually, November the 10th, 2022, this was the first time CPI had actually come in lower than expected. And, that ended up putting in the bottom. We did obviously have one close lower, but, that area through there is pretty much the bottom. So it's about as close as you're going to get, right, to being the bottom. Well, so far it's the local bottom anyway. So, and also it leads to a lot of major moves as well. But it's the major shifts, right, that you have to think about. Because, yeah, okay, you can have a CPI higher or lower or whatever, right? Yeah, great. But it's the big shifts. So when we put the top in the market, right, back here, CPI came out at 6.1% and it was higher, way higher than expected. And, they had to switch from being like inflation is transitory to be like, okay, inflation is a problem. We're going to have to start raising interest rates, right? So that is like a massive shift because the CPI did come out high. It's a massive shift in the policy of how the Federal Reserve has to approach the next moves they're going to make at FOMC and what they're going to do with QE and QT. They have to mechanically switch from focusing on employment to now focusing on the other side of their dual mandate, right? So does that make sense? And then back down here was the same thing, right? They got to switch when we came in from being lower, they got to, the focus of the market was starting to front run the switch that the Federal Reserve were going to have to make soon from focusing on one side of the dual mandate, which was now price stability, bringing inflation down, and front running that they were going to have to start to focus on the other side of dual mandate, which is maximum employment, right? And then that puts in the bottom of the market. So it's those major swing points that have the most effect of the direction of the market, right? Okay, so things to understand. So economics, CPI, right? CPI stands for pretty much consumer inflation, right? How much are you paying for things, right? PPI is another reading that they do. Usually, I think it's a week after CPI. That is business inflation, right? And in layman's terms, that means how much business costs are. So if I'm running a business and I manufacture pens, right? How much does it cost for the plastic, right? The oil that I have to buy that goes into the plastic that makes, the case for the pen, how much does it cost for the ink, the metal, the steel to make the ball bearings, all that sort of stuff. So how much is the business having to spend to get, to create the products that they then sell to the consumers, right? And then PCE, which is consumer spending, that usually comes out at the end of the month. So CPI comes out in the middle of the month. It's usually the second Tuesday of the month. And then PCE usually comes out at the end of the month. It's usually the last Friday of the month. So for this month, I think it comes out on the 31st of March. And this is the PCE is actually the most important one that the Fed watches, but everyone makes a big deal about CPI, right? Because CPI is usually the main one, but they have actually said many times, especially in this bear market, that core PCE is the main one that they watch. And the difference between core, right, and CPI or PCE and core CPI and core PCE is that they remove things like energy and food and stuff like that because those have more seasonal inflation. So, by removing those metrics, they can look at the real underlying core issue of if things are actually going up in price or not, right? So hopefully that makes sense. Okay, so FOMC is the Federal Open Markets Committee. Basically, this is 19 members of the Federal Reserve, because the way that it works is they have offices all over the country. Because if you're American, you probably understand this a little bit more. It's a bit different to how things work in Australia. But the government actually goes from the bottom up in the US. So everything goes from county and then state. So I won't get into that too much, but basically, the counties hold the most power, especially if, militarily as well, the sergeant or the sheriff, I should say, of the county can actually deputize all the people in his area and fight against the state if they need to. It goes back from when the country was first created, right? But this is sort of like a part of that system of government and how it works. So the Federal Reserve is made up of a committee of all of the heads of the Federal Reserves of different states. So yeah, it's an interesting way how it works. Basically, there's 19 of them. They all come together and they meet. Usually it's I can't remember the exact timing for it, but it's almost every 1.5 months, right? So it's basically around 6 weeks on average. And they vote on what interest rates would do, and they have a 2-day meeting, and that's called the FOMC, right? And then in those FOMC meetings, they create something which is really important every 3 months that can massively affect the market, right? And the last one actually came out in December, right? So that was the Q4 event, the dot plot is what I'm talking about. And then this one is going to be at the Q1 dot plot, and it's going to be released next week at FOMC on March 22, right? We're going to go through the dot plot in a second. Okay, so PCE, we've sort of covered this off a little bit before, but basically core PCE is the main inflation reading that Fed watches. So yeah. Okay, so this is what the dot plot is, right? And this is the one that was released on December 14th. I've got the same one in there. I meant to have, oh, here we go. So this is the one that was, I've got okay, don't worry about me. We'll get to it in a second. But basically, I'm going to explain to you guys what the Fed dot plot is, because I think it's really important for you guys to understand, considering we do have a Fed dot plot coming up in about 7 days, right? On the 22nd. Yes, which is basically 8 days, right? Okay, so the Fed dot plot, FOMC dot plot summarizes the FOMC's outlook for the federal funds rate. So they do this anonymously, right? And they all fill out where they believe. And so you can see down here the brackets. So 2022, 2023, 2024, 2025. Those are the years, and each dot is basically where that FOMC member believes the interest rates will be in that percentile. So you can see the percentile down here. So 6, 5.5, 5%, where they believe that the interest rate target is going to be for the Fed funds rate at the end of that year. So you can see, obviously, this one is flat because everybody thought it was going to be around 4.5 to 4.25 by the end of 2022. And obviously it was December. So it was the end of it, right? So here, I'll get into that in a second. Sorry, I'm jumping ahead, right? So basically it was introduced in 2012 and as an effort by the Federal Reserve to be more transparent in its policies. So they're forecasting, so everybody can be like, okay, I understand where, what their plan is over the years. And you can sort of read this, that they're all expecting to hold above 5%, except for only 2 members thinking that would be around 4.75% at the end of 2023. So basically that's telling us they're expecting no rate cuts before the end of the year, right? So 2024, one member was expecting them to hold. Obviously, they're expecting them to hold all the way through 2025. So extremely hawkish, right? I didn't put a slide in here about hawkish and dovish, but basically dovish means that they're more focused on QE and they want to lower rates and help assets grow, right? And hawkish, right? So the hawks, a more mean animal, they attack, they eat doves, right? And mice and stuff like that, where doves are all about peace and loving. So that's sort of a way you can think about it. So the hawks obviously want higher interest rates, right? And then obviously is more bearish for risk assets. So basically, this guy is obviously very hawkish, right? Or it might be a woman. And we can see that there's much more stretched out and then more throughout the range that they're in, but the average is just above 4. So in 2024, general consensus is that they're expecting interest rates to come down. And in 2025, they're expecting them to come down even more. And then they give the long run estimation as well to bring interest rates back to around 2.5% to 3%, right? So it matches up with inflation target of 2 to 3%, right? So investors and economists commonly prepare for most recent FOMC dot plot to previous dot plots to obtain an indication on the direction, hawkish or dovish of monetary policy, right? And it's released quarterly. So we had one in December. I'm going to have one at the end of the month as well, FOMC on 22nd. All right, so yeah, each dot plot represents a Fed member's expectations, where the target rate range will be at the end of the year. Markets generally look at the median level, most dots on that interest rate level, okay? So here's an example of the one from September 21, 2022, right? And we can see here, right, the dots that were in place for 2022, right? And we can see the dots in place for the end of 2023. Obviously, they're a little bit higher, so we're still expecting marginal interest rates still to come, but they thought that most likely they had done all of the raising they needed to do to get the desired outcome of putting pressure on the economy and breaking things like the banks and the housing market and the stock market, right? So they could reduce demand and stop people spending so much money, which is the core PCE data point that they're looking at, right? So it's how much money people are spending. So that's why they do this. Okay, and so how do we use this as traders to help us to predict the future or market moves, right? So you can see here that in 2023, they're all expecting the peak rate to be under 5%, right? And then the December release, the peak rate was above 5% for almost every single member, right? So what happens is only these two members were under 5. So this is telling us that most likely interest rates are going to have to be hiked higher for longer during 2023. So that's obviously going to be more bearish than what the market had priced in. Now, how does this affect the market, right? Let's go and have a quick look at our favorite chart, Mr. ES. Chart hates me today. Okay. Now, this was released on December 14th, right? Let me double check. Yeah, December 14th, right? Which was this day. Let's just have a look here. Right. So this was one where they had CPI the day before. So this was CPI. We pumped up, swept this high, and then capitulated pretty much straight after. And then we came out and we had FOMC here. And then as soon as FOMC came out, you can see the reaction in the market here on the hourly time frame. We can go in a bit deeper, actually. Hopefully, they give us the 5-minute. You guys can see how insane this gets. So this was the lead up into CPI. This was actually a really nice DR breakout trade somewhere around here in the ODR session. And then it kicked in and the market just absolutely launched into CPI and then topped out and rolled over. Went sideways for a little bit. And then this was the FOMC point, right? So you can see down the bottom of the chart, comes out at 2 o'clock. That's when they release all the data and everybody saw these dot plots, right? And they saw the shift in the dot plots go from here up to here. And they actually have all the hedge funds, they have algorithms. It instantly reads the dot plots. And because the dot plots got put higher, bang, instantly market selling, right? And that's why you have this huge shift where the market, okay, just going sideways, whatever. Okay, the dot plots come out higher, nuke, right? Instantly down in just over 40 minutes, almost 100 points in the market, right? And then the follow-on effect from that is we switch from being in an uptrend, right? So we had been pushing higher for quite some time from the bottom, which was also, this was a CPI event down here, by the way, October 13th, when we came out lower than expected. And then you instantly have this change in market direction. And from that point there, we sold off into basically new lows where the market needed to go sideways and regather itself. And then we broke market structure to the upside and pushed up, right? So hopefully that gives you an indication of how all this sort of functions and works. So maybe you can't get the initial reaction, but just understanding, okay, why has there been this reaction from an uptrend into a downtrend and the big sell-off? Like, instead of just being like, oh yeah, I guess, they're going to say something at FOMC and not understanding. Now you can look at the dot plots and you can compare last dot plot to this dot plot and you can instantly understand it just the same way as all the hedge funds do and have their algorithms programmed for, right? So I think this is a pretty cool thing and you really need to understand how it works. And it's going to be, it needs me a dot plot, exactly, right? And then basically there's going to be one, obviously, at the end at FOMC next week. So you'll be able to read it and see what happens. Now, very, very important, guys. This FOMC, we could see the dot plots lowered for 2023, which would be massively bullish for the market. I think I have the link for the dot plots here. It's, you should be able to search for it. I can't remember where I got them from, but it's basically somewhere on the Federal Reserve. But yeah, basically you can just type in Federal Reserve summary of economic projections and it should come up. Right, so hopefully those links help. there's heaps of information on it as well. Like you can get data from like this stuff. Helps give you a bit more of an in-depth breakdown and stuff like that if you need. Well, I think there's a link to it on this side, but if not, you should be able to Google it. Like this is public information. It's super important. They're not trying to hide it, right? Okay, so yeah, basically we're going to see the dot plot come out, and because the banks are starting to break down now, and we're having a massive shift at the moment in the 2-year yield. Like this is huge, even though it's actually starting to bounce at the moment. This has been, I think this is the largest 3-day drop that we've had in like ridiculous amount of time. Like it's breaking records. I think potentially it might even be bigger than the COVID dump. Yeah, I think it's the largest 3-day dump we've had in like 10 years or something out of control. Anyway, as much as you can see on this chart anyway. So yeah, because the 2 years literally dumped a full percentage point, like we went from being at 5 all the way down to 3.8. So 1.2% dump, absolutely massive pullback, 24% in 3 days of trading. Potentially that's going to show up on the dot plot at the end of this month, which would be extremely bullish if these all come in marked under 5 or under 4.5, or, you know, if some people even start to throw under 2 or 3.5, that's going to be signaling, right, a change of character. That's going to be giving us a signal in the direction that the Federal Reserve are planning on pushing the markets and their policy decisions for the rest of the year. Okay, so here's some charts. So CPI historical chart can help. Right, so I'll give you a quick look at this one. Trading economics, right? This is a really good one to see all the releases and when they're going to come out and stuff like that. So obviously we have, where is this? So Tuesday for tonight, 11:30 p.m. We're going to have core inflation, previous consensus. So it needs to be above here. Where's CPI? Can't read this for some reason. Whoops. What am I doing? Okay, so you can go like this. You go countries and tick the United States, and then go impact. And then you go to 3-star impact, and it removes a whole heap of the BS that you don't really want to look at, right? So you can see before when it's 1-star, I was like struggling to find the main ones I was looking for. They're actually highlighted in the red boxes as well. But I just like to remove the stuff you don't really need to see. Anyway, so you have inflation rate year over year, right? The previous last month came at 6.4. Consensus is 6%. Their forecast from what they thought it was going to be from the last time they did an update was 6.1. But the main one that they look at is actually core, because that is without energy and food, right? Okay, so hopefully that helps. Okay, and then this is a really good website as well, and basically gives the current US inflation rates over the last 20 so years, right? And you can see them all through here, just in this very easy to read chart, right? And so we can see here, January 2023, right? The last reading was 6.4, and then the next reading is available on March 14, okay? Right, so 7.9, and now they just changed it. So it used to be they would compare CPI against the last 2 years. They just changed it to the last year. So we used to have to take into account both of these, right? Now they're only taking into account just the last year. So they're comparing inflation year over year to an inflation year that already had 7.9% increase from 2021, okay? So now, after this month, these readings start to get really high, which means when we're in June, they're going to be comparing the current inflation for June, which will be released in July, right? They're going to be comparing the data to a month last year that had 9.1% inflation. So it means it's going to be easier for this inflation reading to come in lower, right? This was a little trick that I used last year to predict when the inflation rate would actually start to come down, right? And I said to everybody, I think in October or November, that's when we're going to start to get lower inflation readings, and it could potentially put a bottom in the market, right? And that was based on looking at this chart here. And I was looking at the October reading. So we went from September, you can see here. So we start off January is 1.4, very low, and it starts to build and it gets higher and higher all through the middle of the year because of the summer years in the US. You know, it stayed pretty flat in between mid fives. And then we had 6.2%, right? And that was when the market actually topped. And so when we went, that was a big jump from 5.4 to 6.2. So that was going to make it easier in October and November and December because we're getting these higher, much higher readings for us to have a lower reading for those months, right? And that ended up putting the bottom of the market on the SPX was literally put in on October 13th on this CPI reading coming in lower than 8%, right? Let's have a look and I'll show you guys. Right? This was when the CPI data was released, right? Instant big sell-off into a really big rally, right? Came down, and I think you guys remember last week we were talking about the weekly gaps, right? Came down and we filled this gap, right? And then reversed out of there. Right. And then into that massive pullback, and that ended up being the bottom of the market. So I was able to put myself into a position where I was looking at this being a potential reversal based off understanding that the inflation readings was starting to come in really hot at the end of the previous year. So it would be easier for these inflation readings to start to come down at the back end of the year. And that ended up being like a really big period of reversal, right? So it can really help you to understand this sort of stuff if you put it into practice. Like, I would never base a trade off that, but it just gives you like a higher time frame edge over the rest of the market, right? Okay, so let's go through some charts to have a look at and to watch. So important ones obviously are the DXY, right? This is really going to help us understand what's happening with the dollar. So all through here, the market was pushing very aggressively, right? And then we end up getting our distribution range happens, right? At the same time as inflation starts to come back down. And we can see it pretty much peaked around this period through here where we started to get those lower CPI readings, right? Because what does a lower CPI reading mean? It means that the Fed is getting closer to being able to reduce its interest rates or the pace of hikes, right? And at that point then, since then, basically the dollar had peaked because it's putting less pressure on, you know, especially the euro dollar system and stuff like that, which is dollars outside of the US and Europe and stuff like that, and Africa and Asia, etc. And you're going to have less access to dollars, right, when you're raising interest rates. And also the Federal Reserve is taking more dollars out of the system as well. So that's going to create dollar scarcity. And the dollar is obviously going to be in an uptrend, right? As that starts to flip and pivot, the dollar breaks down. And so that's sort of like our next signal, right? It took a little bit longer after the interest rates, after CPI sort of gave us the signals, right? And then we broke through the bottom of this distribution range through here, which was on the 10th of November, which was the next CPI date that came in at a really nice level as well. And we had the final capitulation, and then it's just been bleeding out there ever since, right? So you sort of match it up, like the dollar currency index gives us a signal as well. It's breaking out of its uptrend. And then remember, we're talking about trend lines, right? So this is a really good indication here, right? Bouncing multiple times off this trend line. Then you have the breakdown of that. We also have that market structure shift through here, right? Remember how we're talking about market structure shifts and breakdowns, right? And then we break down through there, and that's the end of the distribution range. It's sort of like a bit of a retarded head and shoulders pattern as well, with the head being in the middle, but lower. Yes, you can get a list of the charts. So yeah, DXY, obviously a really important one to keep your eyes on, because this obviously at the same time, everything was happening with the CPI changing directions, give us indication of what the Fed's going to do. And then we get massive shifts of a break in a multi-year uptrend on the DXY into a downtrend, right? After a distribution pattern. So it's telling us things are starting to shift, right? At the same time, right? Where was that? November 10th, right? At the same time, we had this massive push in the SPX, right? So you can sort of see how everything sort of like starts to intertwine and everything affects everything else. All shoulders, head and shoulders. People walking around like this. All right, let's get back to it. So I'll give you guys this. I'll do a screenshot of the slide. Is it possible there could be a paradigm shift where risk/BTC moons while DXY is mooning too? Yeah, I mean, that's definitely happened before. Like, excuse me, I think in 2017, DXY was going up at the same time as Bitcoin. I mean, just because DXY is going up, that just means that generally the dollar is going up against the euro, right? So the euro can be crashing because there's stuff going on in the European economy, in the EU, right? Maybe they're getting like a worse recession or something like that, trade issues, the war in Ukraine. So the euro could be crashing, which is the main thing. I think it's like 60% of the basket that DXY is paired against, right? So the euro could be crashing, which is going to put the DXY higher, and crypto could be moving into a bull run because of, it's post-halving or something like that. So, that's not going to be like, okay, just because the euro is dropping, it's going to mean that Bitcoin can't run. But when the dollar is dropping, it does make life easier for Bitcoin because Bitcoin is mainly paired against the dollar, right? Nice, makes sense. Okay, so yeah, 2-year yields, 5-year yields, 10-year yields, really important to watch, right? Let's go and get those up. So we'll go the 10-year first, which is the highest one. And really interesting at the moment, right? On the 10-year, we did top out at this big bearish divergence. We're going to cover bearish divergence in one of the upcoming sections of the course. So don't stress if you don't understand what that is, but basically it's a reversal indicator, right? And then I ended up putting in the top in here anyway. It's been just in this flag pattern. Pushed up higher through here, and then obviously had that really big throwback. But as you can see right now, we're actually starting to put a bit of a bounce on this trend support through here. So the 10-year, if we break below and start opening and closing below this trend support through here, then I think, that's probably a really strong indication that the Federal Reserve are about to pivot or about to flip, right? Do you take the 30-year into consideration? Yeah, for sure. I mean, I like to look at mainly the 10-year and the 2-year, but yeah, you can look at the higher time frame as well. Right, so then this is the 30-year. So obviously a little bit more bearish. But for me, the main one to watch at the moment is actually the 2-year, because it's leading, right? It's the high, it's the most aggressive, it's the most short term that people are actually trading in and out of, because it's giving the highest yield, right? Usually the longer term bonds give a higher yield, but we actually have something which is called the yield curve inversion. I should get that chart up. Let's see if I can do it. I've forgotten how to get the yield curve inversion up. I think this is it. Right, so this is the what's called as the yield curve inversion, right? And this is, okay, so to get this up, it's T10Y 2Y. So basically it's the comparison of the 10-year treasury bonds, right, with the 2-year treasury bonds, right? And basically it's the gap between the 2-year yield and the 10-year yield, right? So at the moment it's 4.2, and the 10-year is 3.6, pretty much, right? 5.9. So normally the 2-year is a lower yielding bond than the 10-year, but when everything goes to shit, they actually invert and flip, and we get an inversion of the 2-year, 10-year yields, right? And basically every single time that this has happened, we've led to a recession. There was a really good interview the other day on the guy that basically came up with this theory and popularized it. And basically that was after 2008. And he came out and said, pretty much every single time that there's been an inversion of the 2 and 10-year yields, right, gone below zero, we've had a recession. But the thing is, that came out in 2008 after, we're already in a recovery. So, great. Thanks a lot for the help on that one, a bit of hindsight analysis. But anyway, he's come out and he's saying that he doesn't think that it's actually going to play out this time and we will get a soft landing because things are different this time, and gives all these reasons, right? So you guys can check that out if you want to. The Wolf of All Streets was the guy that interviewed him. So you can just search for that on YouTube if you want to and have a look for that video. It was basically like last week or something. I was watching it. You can have a look at all the reasons he goes into, or the reasons why he thinks this time is actually different. And it'll be the first time the 2-year, 10-year it actually inverted and we don't get a really bad recession. But that was before these banks started breaking and going under. So let's see, right? Okay. So yeah, basically we've got one of the guys, man, I don't know how to say your name. And you've been in Discord for years, but Adswagen, English isn't my strong suit. I'm better at reading charts. He just put together a really nice chart for us, which actually gives in, I'm guessing the periods that we have recession is what's marked in as the red, right? Which is usually how you mark these charts. And we can see every time the 2-year inverts, and then we have the recession period after that, okay? So thanks a lot for that, mates. Okay, let's get moving forward. Okay, another one. So does everybody understand the yields? So I probably need to explain that a little bit better for clarity. So this is not the bond, the value of the bond. It's really important to understand that this is not the value of the bond. This is actually the price that you get on the return, the yield, which is the return that you get each year for holding the bond. So let's just say the bonds are $1,000 usually. I think they have like $100 bonds and stuff. I'm not exactly sure, but usually they're $1,000, right? And at the moment, you can buy a government bond when they release it. I'm pretty sure it's every week or every 2 weeks they do releases, and everybody can buy it. Usually it's just the banks that buy them, right? And major institutions and stuff, and like big hedge funds. Not usually many retail are buying them. But anyway, if you can buy a 10-year bond at the moment off the government for 4.2%. Okay, hopefully that makes sense. You can buy a 10-year bond, right? And the yield return you'll get each year for the 10 years will be 3.5%. So this is what's known as the risk-free rate. If you study economics and finance at university, all of the calculations are based, and the calculation will have the risk-free rate written as RF in there, and you have to fill in the RF, which would, for example, would be the 10-year or the 2-year if you're basing it off it, depending on the lifetime of the project. This is when you're doing net present cash flows and everything like that, right? For valuations of projects and things. And you would write in risk-free rate. The risk-free rate is part of the calculation because you have to work out how much the project is going to return you over the lifetime of the project versus just having your money in government bonds, which is just having your money in the risk-free rate. That's why it's so important, guys, because when the risk-free rate of return increases over time, when the Federal Reserve puts it up, it means that there's less projects that you can do that beat the risk-free rate. Because if you can't return for your business, right, over the next 2 years, if you can't return 4.2% over the next 2 years of the project that you're going to run, why the fuck would you run the program? Because you're actually going to lose money relative to holding risk-free, right? So this is how it all sort of actually integrates into, the Federal Reserve puts up interest rates. It affects how businesses run and manage their projects, because you have the finance guys that are running these calculations on every single project that gets proposed to them, right? And they go, okay, we're not going to be able to beat risk-free rate on this, so we're not going to run the program. We can actually lend out this money to a corporation or a business, or maybe we'll do lending for housing or something like that at 8%. So if we can't beat the 8%, why the fuck would we build that building, that skyscraper or building of development project or something like that? Because I can get 12% on my money, lending it to somebody, and then I'm not investing it. Because if you invest, you have more risk, right? Let's just have a look at what happened with the Federal Reserve came and they bailed out depositors, right? Because depositors are debt, right? The bank owes debt is a debt factor to the depositors, right? But if you invested into the bank, you lost all your money, right? And that is because the Federal Reserve, they're always going to favor debt. Debt gets favored first. You don't get favored if you're an investor. So if I'm thinking about myself, okay, I'm going to do a land development or something like that to then build houses on the project, right? And I can only get 14% return on that over the next 2 years, right? But maybe I can lend that money to somebody and then I have the ownership of the debt. So if they go into liquidation, I can then, sue them, or I will be the first in line to get my money back at 12%. Then I'm just going to give the 12% instead of, because the gap that I make is only 2%, but then I have to do all the work, right? That's what's happening right now in Australia. That's what's happening right now in the US. And so then less projects get done because people are more willing to I'll just lend the money out. And then I can just sit back and make the 12% rather than busting my ass and taking all this risk that the project might not work out and I can't sell the houses or the development and even make that 14%. So I'll just lend it out, right? And so then that starts to slow down the economy and puts the brakes on things, and less people are making money, right? And then it flips from one side of the mandate to the other. Okay. Hopefully I didn't just rant for all that time and meant nothing to you guys. Hopefully you got some value out of that. Okay, so junk bonds, JNK. This is a really good one to look at as well. Awesome. That was all new learning for me. Good stuff. I mean, look, it's great to just look at the charts, I think. And, especially if you're just a pure trader and you're like, okay, I'm just going to, all I want to do is focus on my setup. And okay, the RSI is saying this, my crossovers of my moving average is saying this, and I get the pin bar on this key level, right? And that's my entry, right? I think it's great to understand that sort of stuff. But for me, I want to understand what the fuck is actually going on in the world and why is it causing these little lines on these charts to do these things. And I sort of feel like if you have a decent understanding of how things are happening, it makes easier decisions, when you're under a whole heap of pressure, when you're at the top of the market cycle, when I was back here and, I've got, all my friends, when we're up here, so many people asking me to borrow, to lend me money and trade for them or all this sort of stuff like that. And I was like, I'm like, man, this is serious fucking lot of pressure. Even for me, it's really difficult right now. And I think there's potential that we could be topping right now. I don't want to be taking anybody's money to invest into crypto because we're probably about to go into a fucking bear market. The Fed is just hiking rates. That we just had high CPI, so the Fed's going to have to pivot soon into QT. And because I had that higher level sort of understanding of everything that was going on, when you're under pressure, it helps you to make those decisions and then stick to those decisions for long term. Because when you're looking at the market like this, and everybody is super bullish, calling, we're going to hit 400K, it's pretty fucking difficult to sell. Right? So I think if you understand what's actually making the lines on the chart happen, it gives you the higher time frame sort of ability to sort of make calls and stick to them and have a little bit more backing to the trades. Okay, so helpful. People talk about bonds all the time, and I have just considered it irrelevant because I didn't understand it, but super helpful to know a bit more behind why. No, this is alpha. Wow, this makes so much more sense now. Awesome, guys. Economics is so fun. Yeah, I always found it super interesting. Yeah, so it really helps with high time frame bias now. Romps is going to come back. He's going to be like JP Morgan level economist in like 2 weeks. I can already tell. Love it. Okay, junk bonds is the next one that we're going to look at. Right. So this is one thing that I think is pretty cool. So this is actually the price of the bonds, right? And so junk bonds are basically low-level corporation bonds, right? And they're called junk because, you know, the companies are like, okay, they're pretty shit, right? And so the bonds get rated on certain levels. So you probably heard about like the ratings, like Moody's or SP, you know, S&P, like their ratings, like A class or B class or AAA and all that sort of stuff. And this was one of the reasons why the global financial crisis happened, because they basically gave A class ratings to a whole heap of bonds that should have been rated as junk bonds. And so people's pension funds and stuff like that put heaps of money into these mortgage-backed securities, which were a type of bond for houses, right, for people to buy houses. And they were super low-level bonds, and they were getting marked as AAA, right? So that can cause problems, obviously, when they start to go under and you think that they're untouchable, right? So anyway, this is junk bonds. And we actually put in inverse head and shoulders here right at the bottom. So you can see perfect neckline through here. And we had the inverse head and shoulders, right? Broke out. I probably wasted a whole heap of people through here. But then you can see that same date when we had that November CPI on the 10th of November. At launch, we reclaimed the market structure. So, you know, guys like Romps would be looking at this and they would be saying, you know, this is a break of market structure, right? And then we come back up and they're expecting it to sort of push back up again higher. Then once you get the break here of the neckline again, that's confirmation that the market structure is broken and we're pushing to the upside. And you can see that ended up putting in the break of the trend, right? But when this reverses and actually moves to the upside, it's a really strong indication that hedge funds and Wall Street players are moving into risk assets, right? So when this bottoms and starts to take off, like at the moment it looks terrible, right? When this reverses, that is a really good signal that the market is getting ready to fucking gigapump, because junk bonds are a really good sign of risk on from the smart money, okay? Another really good chart to keep note of is S5TH, which is the market breadth of the SPX of the 200 daily moving average, right? So let's get that up. Jenga. Okay, so this is the market breadth, right? Really good indicator, guys, that you can use to help to buy the bottom, especially on the stock market, right? And basically, let's get our stock market up. Okay, so this is the 200 daily moving average. I'm just going to get a clean chart so it's a bit easier to look at. Okay. So what we're going to do, we're going to go indicators, we're going to go moving average. Right. We'll go like this. We'll go 200. And I like to make the 200 moving average red. Sometimes I make it yellow as well if there's too many red stuff on the chart. But basically, we can pull this up and have a look at a whole heap of different charts, right? I'll explain on SPX first, right? But basically, when we're above this, it usually means that we're in a bull market, right? When we're below it, it usually means that we're in a bear market, right? In corrections, you can come back and test it. So this is the 4 hour. I was wondering why I was a bit off. Right, you can come back and test it, but usually it's like the signal that a lot of hedge funds and like high level traders that just trade the SPX, every time it comes back to the 200 daily moving average, they will buy, right? And then when you get under it, it's a major correction, right? So this was the temper tantrum when they tried to raise interest rates. The taper tantrum. Oh, might have been. Oh, that was COVID, right? This was the taper tantrum they talk about a lot, where there's basically a really big pullback in the SPX. And then Trump was like telling Jerome Powell, you have to lower interest rates, right? And so, a lot of trading below here, and potentially, the market, if they continue to raise interest rates, the market potentially could have moved into a bear market in that period, right? Instead, we got what we got. So anyway, usually it bounces off this, and it's just a really good indicator of where the market is priced, if we're bullish or bearish, right? So let's go and have a look at it on a few stocks, right? So Tesla. Right, so we can see here that Tesla is currently below the 200 daily moving average. All right, Amazon. Right, Amazon is currently below the daily 200 as well. Let's go Apple. Okay. Apple is currently above the daily 200 moving average, okay? So what the market breadth indicator tells us, right? It's giving us down the side, the numbers here, they are percentages of how many of the stocks, right? We just looked at 3 of them. How many of the stocks in the S&P 500 displayed in a percentage are above the 200 daily moving average, okay? Does that make sense, guys? I know it's a little bit complicated. I think some of you might be a little bit lost. Some of you might be a bit confused. Cyberpunk is pretty excited about that. Okay, hopefully that makes sense. If anybody has questions about this, how do you get the breadth chart up again? You type in S5TH. Okay, so the signal indicator for this is when price gets below pretty much 20%, right? But for really low levels, right, around 10% will tell us, right? Let's go have a look at these dates. So we're going to take on the dates of, right, that is this Friday, the 17th of June. And we're going to look at when this bottom down here, Thursday, the 29th of September. Okay. Let's get back to ES. Okay. So what were the dates again? Okay. Friday, 17th of June. Okay. So Friday, the 17th of June. That's the 16th if I can get my, all right. So the market breadth came down and hit 10%, and it was the very day that the market bottomed. Okay, what was the next day? The next bottom, okay, it was here. So that is the Tuesday, the 27th of September. Whoops, wrong chart. Okay, Tuesday, the 27th of September. Okay, so it took a little bit longer. It was perfect exact day back here. And then 2 weeks later on the CPI date, we got the bottom, right? So we can see here that we put in an accumulation zone through here, accumulation zone through here, right? What's this? This is an Adam and Eve double bottom, right? Market breadth breaks out of there, right? This is similar sort of pattern, but it's also another type of double bottom, breaks out through there. In both those periods, when we're down here at the 10% level, was the bottom of the market, right? So we can use this when the market, it's basically an indicator to tell us that the market is extremely oversold at the moment, and we should start to look for potential of reversals in price, right? So COVID obviously came down a little bit deeper, but, right, when was the bottom? Okay, I mean, geez, that came down. There was only 2.9% were above. I don't know what it was, what stock. There's only a couple of stocks, right? It's probably like 5 stocks, maybe. No, probably about 10 stocks at S&P 500 were still above at that point. But anyway, let's look at when it got down, and we tagged the 10 was the Thursday, 12th of March. right? 12th of March was here, right? So that was when we, that was when we hit the 10, right? The very bottom of this ended up getting put in on Monday, the 23rd of March, right? Which was obviously the bottom here, right? So yeah, you could have been looking at this and it could have been a signal for you that once we got back, so below the 10, obviously extremely, extremely oversold. So we're going to be looking for a bounce, right? Once we get back above the 10, that's sort of like our signal, right? What was the date that we got back above the 10 was, I think that's the 6th of April. The 6th of April was here. All right. So obviously when the market goes up, it's going to start to drag this up because more stocks are going to get back over the top, right? So we came down to the 10 here on Wednesday, the 26th of 2018. Right. Wednesday, the 26th, 2018, nails the bottom, right? So it's not going to give you the exact bottom every day, but if you just bought every single time the market breadth came down to 10, you're pretty much getting almost the exact bottom of the market every single time, right? Okay, this is in 2016, January 21st. What was the date? Sorry, it was the 19th of January in 2016. Is this cheating? Yes, it is. Okay. Where was it? 19th of January. Okay, 19th of January was just here. So we came down and tagged the 10, right? And you got in at this point here. We did make a lower low, which ended up being a bullish divergence, right? So the way you could look at this, okay, maybe you start to average in around the first tag of the 10, and then the second time you get the tag of the 10, right? Obviously, we see that we've got the bullish divergence in here as well, right? And that would be giving us a pretty strong entry signal. But remember, like with a lot of stuff like this, thanks in advance for the Lambo, no worries. So yeah, this is an amazing tool for especially like long-term investors. Like, okay, you want to wait to get an entry in the stock market. Obviously, it doesn't happen all the time, right? This is a 2-year gap in between these two, right? In between here and here, right, was a couple of months, 6 months, right? That was August 15. That was February. So basically every time it comes back here, you just want to be buying, right? It's pretty much as simple as that. I don't think I need to give more examples. Obviously a weaponry little tool that you can use to give you a lot of alpha over the market. 100% full stacks. But I mean, like, honestly, you could average in when it's around those levels, as long as we're not in like serious, COVID type nukes. You could pretty much just average in on like, low leverage if you wanted to, or the reversal. But I mean, honestly, just buying spot, you're just averaging in to, stocks that you like, or, even cryptos, because it's going to be marking, the crypto is so tightly correlated with the stock market now. These pullbacks, these big pullbacks in the stock market are also going to give tight pullbacks in crypto as well, moving forward into the future. So basically what we're looking for, obviously this has had a really big sell-off recently. If this continues to dump down and we get it below the 20, that's our sort of focus to be on for looking for bottom signals, bottom setups, right? And we get below the 10, that's when, we want to be averaging in, DCAing, or whatever it is for your higher time frame guys. When it breaks back above the 10, that is your signal to sort of, okay, it's really going to start moving to the upside, because usually if you get below the 10, it doesn't spend very long below there, right? KRBN. I don't even know what that is. Let's have a look. Oh, it's ETF. Crane shares global carbon strategy. Interesting. Nice. I have to do a bit of research and learn a bit more about that. Okay, let's keep moving. Okay, the next one is the reverse repo market. This is one I've been chatting with Creddy for a little bit about. He likes this chart. And basically, it's just one to keep your eye on for sure, because this is the overnight reserve repurchase agreements, right? Treasury securities sold by the Federal Reserve in the temporary open market operations, right? So basically, it's $2.12 trillion of capital held by the Federal Reserve. I'm pretty sure actually the Treasury holds this. So Janet Yellen is the person that's in the head of the Treasury. She oversees this. And basically, when we see this move into a downtrend and start to head back down, basically it means that they're injecting money back into the economy. If you want to know more about this, so basically it's like a form of hidden QE. So they can basically do QE when money is coming out of this back into the economy. It's basically like QE. So they can do a hidden version of QE without the Federal Reserve being like, yeah, we're doing QE. So it's one to keep your eye on, because if this starts to drop off quite aggressively, basically it means they're injecting capital into the markets, printing without printing, right? And you can see since they started their QT back in March 2021, it's gone through the roof. So this is like them sucking money out of the economy. When we go back into QE or financial conditions start to ease, it's going to start injecting back into it, right? And this will start to come down and markets will be pumping. So don't get caught out if this is dropping and markets pumping and you're like, the Fed hasn't started QE yet. Like, what's going on? They actually could be doing QE through the Treasury and through the reverse repo markets. If you want to learn more about this on much deeper, there's probably about half an hour worth of reading. If you go and read Arthur Hayes's blog, he talks about this a fair bit. There's a couple of blogs where he talks about this, so you can go into research into that. Okay, I'm dragging my feet a little bit here, guys. Sorry. Okay, so charts to watch. So yeah, earnings, right? This is a really good little tool that you can use for earnings reports. Okay, so Yahoo Finance, it comes up with all the data when they're going to be released, right? And it will tell you if there's a surprise percentage to the upside or the downside. So you can see here that Apple, in their February earnings report, actually there was a surprise to the downside by 2.89%. So we can look at these earnings, and this is going to become really important soon because we're starting to shift from one side of the dual mandate to the other, right? We're starting to shift from CPI being the most important thing to now earnings and unemployment being the most important thing, right? We'll look at unemployment in a second on the chart, but basically Apple, which is one of the biggest company on the planet, is the stock market leader that has the most percentages. The SPX is weighted in Apple than any other company, right? So you could say it's the most important, but all the top 10 make up about 30 something percent. I think it's actually like the top 6 make up like 30 something percent of the NASDAQ. I don't know about the SPX, sorry, but it's a large percentage. Anyway, so they just had, look at this. They're pretty much always green. When was the last time they had red? 4.9. That was in 2016 when we had one of those pullbacks, right? Very rare that they have downside upsets, right? Last time they had one, sort of this size in 2011, 2012, right? And when we're coming out of the bear market. So yeah, this is the first time they have had a negative earnings report, surprise to the downside, since 2016. So if this continues to be a trend, and there's other companies like Microsoft and Intel and Amazon and all these companies, they start to show these negative earnings reports, and then we start to see unemployment start to raise, then that could be a problem, guys, right? Okay, so let's get up our SPX. What I'm going to do here, I'm going to show you a trick. So this button up here, you can press that button and you can get data come up. So and I've got them all listed here, right? So yours won't show up, so you're actually going to have to search for them, right? So I'd have to type in USCCPI, right? And you can help yourself by going to economy, clicking on this button here, right? When you're typing in stuff. It has a lot of them listed here, right? So we've got obviously United States core CPI year over year, right? And I can have it as the same percentage scale as what's over here. Or I always go new price scale. Can you go new pane? But I want to do new price scale and put it over the top here, right? So this is going to give me a chart of CPI over the top. We're going to get rid of our moving average, right? And then the data is going to be showing over here. So at the moment, this is core CPI, which is 5.4, okay? I think there's a way to get actual CPI up, but I've forgotten what the code is. I think you had it up before, Critty. The other one as well that we want to have up is unemployment rate, right? So I'm going to go new price scale for this one as well, right? And then we're just going to go back and have a look at how these charts generally interact with each other. Okay, so we can see in COVID, unemployment went through the roof. So what did the Federal Reserve do? They had the dual mandate to the other side that what we currently have right now, and they turned on QE, so lowering interest rates and pumping quantitative easing. Unemployment rate, call sign, and trading view is unrate, UN rate. Okay. So yeah, unemployment goes to the roof. They turn on QE, and spending goes in, right? Unemployment comes down, but what happens over time? It took a little while, but core CPI starts to raise, right? Then obviously they get to this point here. They go, okay, it's a problem now, and then they switch to QE, and it starts to come back down. Right now, let's go back in time a little bit, and we're going to have a look at the previous market cycles and see how CPI interacted with each other. Okay, so we can see here that this is the last bear market in 2008 when we had the global financial crisis, right? And we can see that we had this breakout here of the falling descending wedge, right? And that was actually before CPI peaked. So CPI peaked and unemployment was starting to raise as CPI was going up, right? As the market was capitulating quite aggressively. But CPI ended up peaking. And then after CPI peaked, that was when unemployment really launched and became quite a problem, going up to 9%, right? At the moment, I think we're sitting at 3.6%, right? We just had, it went to the lows basically. Let me just pull that up a little. Went to the lows, but it was expected to be 3.4 and actually came out 3.6. So potentially this is going to start to move more to the upside as CPI starts to come down, with the market coming down as well. All right, let me just reset the chart. All right, so now CPI is topped, right? Now we're looking to see what CPI does next. And if unemployment starts to take up. If they can keep unemployment down this low, then that's going to give us a really good indication that the market could end up landing a soft landing, right? Okay, let's go back and have a look at the previous cycle. Okay, I need to change chart. Get rid of this volume. Okay, so this is now, that's 2008, right? So now we're going to look at the 2000 bubble, right? So this is .com bubble, right? So CPI topped, right? Maxed out here. As soon it ended up actually doing a double top, right? And they were raising interest rates, right? Interest rates start to get lowered. And after CPI tops, you can see here that that's when unemployment starts to take off. So it's really important now to watch to see if unemployment starts to take off, because unemployment taking off, that's when they will eventually have to switch to QE. But when unemployment starts to take off, that's when the economy starts to move into that final sort of capitulation area, and we get that really big sell-off. Now, this is one of the reasons why, because unemployment is still so low, this is one of the reasons why the yield curve inversion guy is saying that we won't get a big recession and max capitulation like what we had in previous bear markets, because unemployment is still pretty much at max, right? So this is an indicator we need to keep our eyes on, because if this starts to creep up and things like Apple earnings start to get worse and worse over the next few months, that's when we're going to start to see the market react really negatively and get that move into final capitulation. Okay, so we're starting to have that switch on the things that we need to focus on from being CPI. It's going to become less important, and it's going to become more important what happens with the unemployment rate and earnings. Okay, so charts to watch. I'll copy these for you guys as well. There's some good ones that you can get up and have a look at, okay? Okay, so this is a really cool indicator. You can put it onto your trading view through this. Oops. And basically this is what it looks like. And it was made by an influencer guy who's on Twitter. He's pretty cool. You might want to follow him. He gives a lot of good information about what's going on in the economy. His name is TED Talks Macro. And basically what it is central bank liquidity. And it shows all the data of the central banks basically and how much QE or QT they're actually doing at the time, and it maps them over the top of each other. So we're not just looking at what the US is doing, but we're looking at all different markets, and then we can sort of line that up with our charts, and you can see over the period that when, let's get it up on the chart. I think I actually have this on one of my charts already. See if I can find it. No. Okay, 1 second. Okay, so you can go to basically the link that I just gave you guys here, and you can click on here and go add to favorites, right? And so major central bank. So what I'm going to do, I'm just going to clear this. Okay. And then we're going to go to indicators. I need to be on the daily time frame to use this properly. And one of the tips that you want to use for this is you want to turn on the labels. Here we go. Symbol, label, name. Oops. We can get it for the indicator. That would be nice too. Okay. There we go. So you got a little cog down here and you go labels. Symbol, label, name will be that one up here for the chart that you're on. Right. And then indicators and financials, names, labels, right, will give you for the indicator. Okay, so you can also go into this and you can switch them on and off as well. So if you only want the Fed ones, right, you can switch those on and you can only look at what the US is doing, right? Or you can turn them all on and you can look at what the PBOC, which is the Chinese central bank, Bank of Japan, the ECB, which is a European central bank, right? You can have a look at what they're all doing, because obviously that affects, with the global markets, when capital is being injected into different markets around the world, they all add up and they flow into assets, right? It's not just singular what the US is doing. So you can have a look at this and see how it plays out in the markets, right? We can see how this affects the price of Bitcoin, right? So you can see here that for this entire period of the last BTC bull run, there was a lot of printing going on, and the indicator was actually moving to the upside. When we moved into our bear market, was actually, we can see, right, all through the entire bear market, there was actually a downtrend through global liquidity of the central banks, right? Let's get it up and remove some of these. We'll get rid of the Chinese, ECB, Bank of Japan, right? And this is just the US markets, right? So we can see through here that for a long period through here, they were pushing a lot of capital into the markets, right? And just as, our market sort of topped out, that was when, this started rolling over and pushing back down on a much steeper curve, right? And obviously, when COVID happened, the liquidity kicked in like crazy, and then you can see the result. Okay, but basically, another thing that you guys should probably know is in early December, they announced they were going to move for the first time from QE into QT, and they flipped back into QE somewhere around this period here. They announced it, and you can see that the QE ended up starting later on that year through here, and we start to move to the upside. And that was what ended up ultimately putting in the bottom here, right? So a lot of people like to say, oh yeah, you don't need to know much about macro, but at the top here, they announced pretty much that they were going to move into QT, and we had a full year of downtrend bear market. And then they announced that we're going to move back into QE, and the market rallied a couple of 100% from there. And it moves in advance of obviously when it happens. But this is a good just indicator to show you how it all sort of works out. Okay. These are some accounts to follow, which are pretty handy on Twitter, if you want to check those guys out. Assad is really good. He runs a hedge fund in Australia. And Jurian Timmer is also amazing as well. He's the CIO of Fidelity. Okay, I'm draining a little bit now. Why Zero Hedge? He puts out some good info. He's a little bit crazy, but he does put out very fast updates. Okay, we're sort of pushing for time here. I might just quickly pump out this psychology stuff, Romps, and then we can go and jump into your candlestick stuff if you want to do it that way after me. I'm just going to grab water quickly. Okay, guys, that was the economics section of the course. Hopefully that helped. You guys got some stuff out of that. If there are any questions or anything like that, how much protein? This is actually electrolytes and water. Because I was in the sun for a bit today down at the beach. I'm pretty burnt. So yeah, hopefully that helped you guys and gave you guys a little bit extra edge for the coming cycles of the market. Hopefully it'll help you guys out, make those major decisions, right? I never really base a trade off that because, we want to be digging down deeper, but it does give you the higher time frame sort of angles to go in, right? Helps to craft your higher time frame bias, right? So then we can focus on nailing the setups in the direction we want to be trading into. The only one I would really base a trade off would be the market breadth indicator, all right? So yeah, we're going to punch out a whole heap of stuff on trading psychology here. And this is some really cool content I think will help you guys. Because trading is a tough game, and a lot of it comes, if we're successful as a trader or not, a lot of it's going to come down to our psychology, right? Because you can know everything, but if your psychology is off, you're going to shoot yourself in the foot, basically. So this trading psychology lesson is called "You Are What You Think You Are." Okay, so basically, There's been a lot of research into this. And if anybody's done any Tony Robbins courses or anything like that, which I actually have done a lot of, he talks about the concept of your reticular activation, excuse me, your reticular activation system, and how focusing on different things and self-talk and stuff like that can control and create your reality, right? So the basics of this idea is your thoughts and beliefs have a powerful effect on how you live your life. So very important question to ask yourself right now is, are you aware of the thoughts that you have, or your thoughts just controlling you in every single thing that you do, right? How do you talk to yourself each day? Are you kind to yourself? Are you positive? Are you uplifting? Do you tell yourself how beautiful, amazing, handsome, how strong you are, how much of a legend you are? Or are you constantly attacking yourself, telling yourself you're a dumbass, you're a loser, can't believe you did that, can't believe you made that mistake, can't believe you said that embarrassing thing in front of that hot girl that one time 10 years ago, or in front of that hot girl, right? You know, it's dumb things that you've done before in your past. You're constantly recycling those thoughts in your head and causing yourself negative emotions that you're holding on to, right? Are you super critical of yourself? I think it is important to be critical of yourself because you can learn from that and expect good things of yourself. But there's a big difference in between, you know, expecting good things and great things of yourself and just constantly attacking yourself and pulling yourself down and creating that negative reality for yourself, right? So we're going to dig into it a little bit deeper. I'm learning to trade so I can talk to hot girls. It is easier when you're rich. Each of these thought patterns create pathways that link and bond over time. So, you know, you talk to psychologists, they always say neurons that fire together, bond together, or something like that. What if neurons that fire together, wire together, right? Number one thing for me being successful in the cycle for me. Awesome. Anyway, so neurons that fire together, wire together, right? So if you're a negative self-talking person constantly attacking yourself, when there is a situation in life that it gets presented to you, you're more likely to take a negative perception of that rather than a positive expectation from that. And that creates the reality that you end up experiencing, right? I'm going to tell you a story, right, about these two people, exactly the same person, identical twins, right, sitting next to each other on a plane. And the plane takes off and it's flying along. They're going around the world trip. They're excited to go on the flight or whatever. And, you know, one of the engines starts to break apart, and there's, you know, a mayday call comes out. Everybody's freaking out. Two people on the plane that, oh my God, what is going on? Anyway, the plane crashes. Both of them get horrifically injured, right? Arms all burnt up and scratched off. You know, both of them break their right leg really, really badly, and they're in hospital, and they get interviewed by someone. And, you know, the first twin is like, oh my God, I'm going to sue the airline. I can't believe this happened to me. You know, the one time I get on a flight to go travel around the world, I was so excited. You just completely ruined my life. Now I've got a broken leg. I have to sit in hospital. I can't believe this has happened. You know, I'm going to make all these people pay for this. This is BS, blah, blah, blah. And they're just so angry and negative and attacking. And then they go and interview the other twin and they go, oh my God, I am so lucky to be alive. So many other people died on that plane. I'm just so grateful that for some reason I was one of the people that the universe or God chose to make it through. And the only thing that I have to deal with is a broken leg, right? So these two people, exactly the same experience, lived through exactly the same thing, have two completely different outcomes of the same reality. And the crazy thing is, guys, every single day, the exact same thing happens to us on minor levels all day, every day. And when you're aware of this, I actually see this happen in reality in life all the time. And I laugh at it when I see it happen, right? right? And sorry to the ladies, but I see women do this a lot. I see men do this a lot as well. And it happens a lot when when you're out at a nightclub or you're interacting with people and you see opposite sexes interacting with each other, and the insecurities come out about the way that people think about themselves. They're not good enough to get some person because they're too successful or too rich or they're too attractive for them or something like that. And the negative connotation of who they are in life makes them doubt themselves, and then they perceive the other person as attacking them when in reality they're actually not attacking them. And then they get offended, and then they get upset, and then they create a negative interaction with that person. So then they don't end up hooking up with that person or getting that person's number, and they end up causing a drama and a fight and a negative experience. Whereas, somebody that has confidence and they're happy about their life, they have the same conversation with the same person and they receive a completely different interaction with that person. Maybe they get their number or have a nice interaction or experience with them. And it's the same way in business, right? If you go into a business meeting and you're expecting the person to be rude to you and reject your offer, then, as soon as they start giving little hints or, what you perceive as a hint that they're not enjoying the presentation or something like that, you're going to create a negative experience. And the reality that you're creating is you're creating a reality to get rejected. And that's why some people in life, and they're usually positive people, they just attract people to them and they experience good things. They have good business deals and they have success, and other people, they just negate people and they push them away from themselves, right? Because they're always choosing the negative pathway and they're creating that negative reality for themselves because they're focusing on the negative instead of focusing on the positive, right? So if you're having an interaction with a woman and you're talking to them and you're like, oh, they don't think that I'm rich enough because I'm a shit trader, and they make a joke, right, about maybe you being poor or something, then you're going to get upset. I can't believe you'd say that. I'm not a shit trader. You're a fucking bitch. Blah, blah, blah. I know this 6 strategy. And they're going to be like, whoa, what the hell? But if you're really confident in yourself, maybe you just laugh at that, right? And then you end up, having a good relationship with that person, right? It's two people, two different ways that you can experience the exact same reality, and then you create the reality, either a good reality or a bad reality. And guys, the reason why I'm telling you this story is because we do this in the charts every single day when we're taking our trades. If you are looking at a trade and you are focused on the trade not playing out, what are you going to do? As soon as it starts going in the other direction, you're going to cut the trade. Right? How many times have you been in a setup and you're worried, you're stressed out, and you're like, oh no, like this trade, I've just taken a loss on the last few trades. This one's probably not going to play out. Oh, I'm down, I'm down a couple of percent. I'm going to cut the trade before it hits my stop loss because it's going to hit my stop loss anyway. And then it reverses and plays out and it would have hit your take profit target. And then you're sitting there like a dick and just going, oh my God, if I had have just not done anything and traded my setup, then I would have actually made money. Right? Yeah, exactly. Right. Bob Lucas says the charts and your success are a mirror of your personal psychology in your life. 100%. Right? If you're focusing on negative, you're going to create a negative reality. You're going to create a negative experience and you get that negative feedback, right? Okay, there's a really famous story that hypnotherapists and NLP practitioners teach all the time. And it's the story of the 2 wolves, right? And basically in life, the story of the 2 wolves, basically, imagine a scenario where there's this little Indian boy and he lives in the forest with his family and his teepee and his hut, and he has these 2 pet wolves. And the start of, he's a young boy and they're very small. There's a white wolf and a black wolf, and he continually feeds the wolves throughout his life, right? And one of the wolves is a bad, evil wolf, and the other wolf is a good, loving, helpful wolf that protects the family, right? And throughout his life, every single time he makes a decision, right, he can make the decision to either feed the bad and negative wolf, or he can feed the good wolf, right? And whichever wolf that he feeds over time is going to become stronger and more powerful. And that will either attack the family and his environment and his people, or it will protect them, right? And the same thing we do every single time in our lives, right? So it sounds like BTC is pumping. I'm just gonna have a little look. Okay, maybe not so much, unless my chart is off. Anyway, let's keep going. So hopefully that sort of like resonates with you a little bit about the story of the two wolves and the two people on the plane. Okay, now I'm going to go even deeper, right? So there was an experiment conducted by Robert Clerk, right, at Dartmouth College. Look this up if you want to. He asked makeup artists to paint big scars on a few women's faces, and then they were asked to have a conversation with strangers. Before they walked in, the makeup artist said, okay, your makeup needs a little bit of a touch up, and they went over there and fixed up their makeup for them, right? After they finished their conversation, the women came out saying that they were feeling awkward and that the strangers were staring at their scars and people were ruder to them than they normally would, right? Nothing really surprising there, okay? But let's look at what happened actually in reality. Before the women left the makeup room, researchers actually removed their scars when they came over to them and they said, hey, your makeup needs a little bit of a touch up. So the women actually went out into the room to interact with everybody with just their normal face and normal makeup on, right? These women, in fact, just looked like their normal self, but they still reported heightened levels of discrimination and rudeness from their interactions. And some even reported that their people were looking and mocking their scars on their faces that weren't even there in reality, right? So this study shows the power of the mind and self-perception to create the reality around us and give us false feedback, even produce results that we possibly do not want. Right? And this is part of something called your reticular activation system, your RAS. And so a really good example of the RAS is when you are driving a car. And so when you're driving around on the roads, whatever, you see cars all over the place, but then you think, okay, I want to buy a new car, right? And so you go shopping for a new car and you're like, yeah, I'm going to get this new car, right? And then you're driving home from the shops and, you start to see that same car absolutely everyone, right? So when because the reason why you're starting it was always there, but now you're focused on it. Your reticular activation system is actually focused on that new car that you're looking for, right? That you were looking at buying. So your reticular activation system focuses in on particular parts of things that we tell ourselves to be aware of. And if we're focused on the negative outcome all the time, we're going to focus on that and it's going to mess up our trading. If we're focused on the positive outcome and our trades playing out, and we have good self-talk, then it's more likely that we're going to actually create the reality where we have more trades become successful, right? And we're going to make less errors. So reticular activation system, right? I just told that story, so we don't need to go through that. Okay, so how do you think that affects us traders? If you consistently talk down to yourself, tell yourself that you're a failure, do you think this will help be a consistently profitable trader? Or do you think that you might hesitate and miss setups that are obvious or close a setup too early, right? If you're locked in and focused on losing your trade, how can you expect the trade to end up being a winner? Most likely you will find a way to lose money when the market is giving you the easiest setups possible. Right. And this is why bias is so important, because if your bias is bearish while the market is actually bullish and moving up, you're going to make up all the reasons in your head why something's not going to go out and play out to a higher target and you're going to cut early and stuff like that, right? So what we have to do is we have to train our brain to think positively and see trades playing out to our targets. If you are hesitating in your setups, it's most likely because you're not confident enough in your trading system that you're using. So what you need to do is you need to get more data, back test, and see the setup play out 100 times at minimum, and then forward test after that to collect the data on it live while you're journaling, so then you know your strike rate, you know your numbers. Forward testing, because back testing is helpful, but you have to also forward test and track your data moving forward, right? That's why I gave you guys watched me for almost an hour last week, back testing that simple strategy that I taught you guys, and we made 55R. right? Over like a 6 to 8 month period. And then I gave you guys the system to track all of those, right? As well. So then you can back test it, and then you can also forward test it. And that will help you, whatever your system is, that will help, right? Get your RAS focused in on winning these trades time after time after time, because you've seen it play out hundreds of times. Okay. So this is how everything I just told you, right? It's all set up to focus on this one thing so you can focus in on your trades becoming successful, right? Because you know the data, you've seen it happen. You don't have to second guess it. You don't have to wonder, because you've proven to yourself that it will. Okay, now, really important shift in psychology around losing trades, right? Do you get upset at yourself if you lose a trade? Or are you getting upset at yourself because you didn't follow your rules, right? Two very big distinctions. Losing in trading is part of the game. Any business has a cost of doing business, right? We don't really have cost of doing business about, paying for indicators or, doing a course or something like that to learn. There's no real ongoing costs of our business. There's no cost of goods sold. The cost of goods sold as a trader is taking losses. It's part of the game. You can't get upset. Or no one trades at 100%, right? Even some of the best traders in the world, they're trading at 60%, 70%. Like we looked at last week, right? You can trade on a 20% strike rate and still be profitable, right? So getting stopped out is the cost of doing business, right? What you should really be getting upset about at yourself over is if you do not follow your rules. How many times have you gone through, taken trades and, you took a trade and you took a loss, but it was perfectly part of your rules and you're upset about it, right? I never get upset at myself if I take a trade that's defined in my rules and then it doesn't play out. Okay, this is cost of doing business. But when I do get really pissed off at myself is if I do dumb stuff, I'm like, oh, this looks like it's going to do X. I'm just going to take a trade here for no freaking reason. That's when I get upset at myself, right? Because you're breaking your edge. How the hell are you supposed to, your edge is designed, right? So you have a system that works for you. If you continually do that system over the long term, you win. If you start doing random stuff in between there, it's going to mess up all your stats, throw them out the window, right? Okay, so what do I got here? Okay, so a really good sort of mindset to be in is imagine yourself as if you were actually working for a hedge fund trading for them, right? Working for a prop firm. Imagine every single move you had a risk manager looking over your shoulder, watching every single trade that goes through on your screen on their own system, right? And they were auditing every single trade that you took to see if you were following the rules that you've been given to follow, right? And if you broke those rules, you would get fired, right? How would you act, right? If you went to your job and just started breaking all the rules that they told you, right? Imagine, okay, let's say you're working for Macca's and they teach you how to make the burger and you're like, you know what? Just going to start making them different. How long do you think you're going to be in a job for, right? Who goes to their job and just starts breaking all the rules, right? So then why do you break your own rules for your own job of trading, right? Okay. Trading psychology. If you work in the health sector and treat patients, after every single client you need to write up a report. This can be reviewed by governing bodies if you get investigated or audited, right? All that information has to be there, right? You have to treat trading as exactly just as serious, right? So get serious, treat it like a business, right? Would you just randomly start taking trades all the time, breaking your rules, not recording any of the data that you're doing if you're a serious business? No. If you had investors, no, because people will get pissed off at you. You lose your job, you're losing your investors, right? So a little tool that I'm going to give you guys to use is the Demon Finder. And this is something that can help keep you accountable and stop you from breaking your rules, right? So here we go. It's a little Excel spreadsheet, right? And basically what you do, I'll copy this later on in the chat group on Discord. But basically what we do is you have the sins, right? And these are the things that you do when you break your rules, right? So took the trade off too early, didn't take the planned trade, wrong size, entered too soon, too late, buying a breakout, whatever it is that, you're doing that, you're making mistakes doing, right? And then you basically put in an X in each of these, right? And after about 4 to 5 times you do this, it will bring into your reticular activation system to stop making this mistake, right? It works really, really well, right? Because it brings it into your RAS and it stops you from making these mistakes, right? And then basically the way that this works is if you fill this out and get to this point here, right, where you get to more than 9 of these, you need to stop trading and give yourself a slap because you've got some serious problems. Okay, and then I put in an extra column down the side here, which is the solution. So if you want to put in a solution to whatever your issue is that you have that you continue to do, maybe that can help as well. So you have you're getting your bad marks, and then you can also relook at the solution as well, what you need to focus on doing. Okay. So back to the title of this training, you are what you think you are. Our thoughts become decisions. Those decisions become actions. 95% of our actions are based on unconscious, memorized programming. Only 5% of everything that we think about actually happens in the conscious mind. Everything else actually happens in our subconscious mind, right? This means our unconscious self-talk is running 95% of all our actions, guys. Super important. Right? We need to be aware of unconscious patterns and behaviors, right? Because these will affect our actions and how we perform when we do things, right? Which thoughts have been leading to how you have been feeling and emotionally reacting to lately, right? Good question to ask yourself. The process, right? So what we're going to talk about now is metacognition, right? Metacognition is the process of thinking about your thinking, the ability to reflect and assess your thinking process. It involves being aware of your thoughts and understanding how they are used to control how you act and react. Literally what we're going to do here, guys, I'm going to give you a tool that you can use to program your subconscious to help you become a better trader, right? So check in with yourself regularly 3 times per day for 5 minutes and identify thoughts, right? What you're thinking about. Check in on how you're feeling and how those thoughts are actually making you feel, right? You track your thoughts and write them down 3 times per day, just for a couple of minutes. Evaluate your thoughts. Are they harmful or are they helpful, right? Challenge the negative thoughts, right, that you have and try to replace them with positive thoughts, right? So a lot of people, oh, it might be thinking, oh, I'm such a loser. I'm not smart enough to do this trading thing. I'm never going to be successful. Right? So you need to challenge that thought. Write it down on the piece of paper, put a line down the middle of the pad, and then you challenge that thought on the other side of the pad. What are are you actually dumb, right? Are you actually not smart enough to make it in trading, right? Are there other people that have, that probably aren't as smart as you that have actually become successful traders, right? And you challenge the negative thoughts that you're using to attack yourself and bring yourself down, and you replace those thoughts with positive, reaffirming, high vibrational thoughts, right? And then what you continue to do that over time, and eventually what will happen, instead of having the negative thoughts, we're literally programming ourselves from feeding the black wolf to feeding the white wolf, right? We're switching from being the person who's angry and bitter about the plane crash to being positive about the plane crash and being grateful for surviving, right? So this is a really good exercise that you can do to challenge your thoughts and start to program your subconscious, right? And you don't need to, when you're doing this, you don't need to be like, no, I'm going to become a multi-millionaire and I'm going to have 5 Lambos and stuff like that. No, you want it to be like real information, like, okay, I'm a dumbass. I'm not even going to be successful as a trader. Okay, let's put a line down the middle of the page. If I work really hard at this and I do a few courses and I work really hard at this for the next couple of years, is it possible that I can become a profitable trader? And what are the things that I can do to help me increase my edge and help me consistently not break my rules and trade within my rules? And if I do that, is it more likely that I will be profitable long-term, right? How do you eat an elephant? 1 bite at a time. Exactly. And you slowly build on it and it will get you out of that negative sort of cycle, okay? So this is what you do. So we have a negative thoughts, and then we have on the other side of the page, we have our replacement positive thoughts. Okay, so the next time you're making excuses for something, like you're not going to go to the gym, or you're not tracking your trades, or you're not following your rules, right? When you are no longer in that state of mind, I want you guys to go back, write it down, and I want you to go back and read what you sound like when you're in that moment, when you're having a little bitch about not going to the gym that day, right? Or you're having a little bitch about not wanting to track your trades or not follow your rules or whatever. And then write it down quickly, exactly the thoughts that you were feeling when you wanted to make that action. Write that down. And then a couple of hours later or the next day, when you're in a different state of mind, go back and read that and just have a feeling of the type of person that you are in that moment, because you'll probably be disgusted by them. All right. So every time you do this, the last thing you want to write down is you are what you think you are, right? This is another trick that we're telling our reticular activation system to refocus on being more positive. Okay. Okay. So a little famous quote from Bruce Lee that I really like: do not pray for an easy life. Pray for the strength to endure a difficult one. Okay. And then the last thing I'm going to leave you guys with today, the best thing that you can do for your trading psychology is write down your set of rules, right? Test your rules over and over and over and over again, and then strictly follow those rules. Because if you do that, you don't need no bullshit story about plane crashes and wolves and reticular activation systems. You don't need fucking Tony Robbins, right? You don't even need the demon finder to give yourself a slap on the wrist every time you do something wrong, because all you're doing is setting down your rules, testing your rules, and then following them, right? And that should just be the end of it. If you do that, you don't need trading psychology, because you're just following your rules, right? So hopefully this sort of stuff helps you out, guys. And if you don't like the voodoo psychology stuff and you think it's a load of shit, just follow your fucking rules and you won't need it. And if you're not having success and you're wondering why, and you don't have a set of rules and you're not strictly following them, maybe that's why. Rule number 1, score 5 on the demon finder. Solution 3, 3 deck member hard reset start. Check yourself before you wreck yourself. I like the straight select sometimes, mate. I need it. Yeah, everybody needs it sometimes, for sure. Even myself. So yeah, that is it for tonight, guys. Roms, we have gone super over. So I don't know if you want to still jump on and do your thing, or should we wrap it up there? And we can do it in the next session when we've probably got a few more people on. We'll go over chart psychology. We can do that in the next session, because I think that's going to be a little bit shorter, actually. Yeah, so guys, do you guys want to stick around for a little bit longer? Because Romps does have some cool stuff. He's sort of keen to jump on. Awesome. Let's have the encore then. We need to get you up. Okay. Phil said makes sense. Thanks for that one. No worries, mate. Okay, let's need to work out how to get you in here, man. Okay, I think it's in participants. Attendees. Why can't I see attendees? What is your fundamentals of magical? Very nice. All right, we need to work out how to get you on, Romps. For some reason, when participants, I can listen. Oh, here we go. Put his hand up. Allow to talk. Promote to panelist. Here we go. You should be able to accept a panelist. Okay. Okay, so if I stop sharing screen, can you speak? I can't hear you.
I'm on now, mate. Can you hear me?
Yep, can hear you. Okay,
Yeah,
now we
sweet.
need
I think if you want video, you want to look at my ugly face, you can unlock it.
So what I need to do, oh, make host. There you go. So I think you're the host now. Yes, you're the host. So you should be able to share screen now.
Beautiful. All right, let me have a look here. I've got so many screens on here. I'm trying to see which one to share. Probably this one here. Beauty. You can see my screen, everyone?
Yeah, very nice.
Yeah, beautiful. Okay, so I'll just go through a little bit more of that psychology stuff. Yeah, that lesson was fucking awesome, Dax. I appreciate that. Hey, like even I was a student at the time and learned a fair bit from it. So we've kept you guys up for a bit. So I'll be pretty quick. I'll probably just read straight through the slides and try not to ramble on too much. So going based off the psychology stuff that Dax just went through, here's a bit of stuff that helped me as well. So this is personality type. As we have just discussed the importance of self-affirmations and checking on our conscious positive thinking, we can take an extra step in learning the inner workings of ourselves to identify our weaknesses and work on them. So one way to do this is through 16 personalities test. So I can put the link in down here. If anyone who wants to go a little bit further in discovering themselves and some of their strengths and weaknesses and that sort of thing, they can do this here. I'll just type it in here. I'll spell it properly. I'm going to put that HTTPS thing in there. Hey? So annoying. Anyway, so I'll have the shop here. Sweet. So getting into this, so what this website will do is it allows you to basically break down by doing a pretty. The test doesn't take too long, but it lets you break down into your personality types: analysts, diplomats, sentinels, and explorers. So from this, my result came to as the advocate. So from this, I was able to sort of identify what my weaknesses were. So like if you're training in the gym or whatever, you're going to trade for a bodybuilding competition or something, you don't want to be focusing solely on your strengths all the time. Obviously, you'll end up looking silly. You want to be focusing on some of those weaknesses to bring up. So that's what's really good here with doing one of these personality tests. You can sort of learn a little bit about yourself and then find out what your weaknesses are. And then we'll go on to the next slide. I'll chat a bit more about this. In doing one of these tests, you can find what your strengths and weaknesses are. You might find yourself emotional and impulsive. So you need to be consciously aware of that and build strategies and rules based on those weaknesses. It could be only allowing your entries to be limit orders. And if you are having a session where you're getting flustered and unfocused, your rule is to walk away from the screen. It could be that you're really OCD and very logical minded. So you might want to build strategies more based on metrics and quantitative data than entering off a technical pattern. So a quote here: if you know the enemy and know yourself, you need not fear the results of 100 battles. If you know yourself but not the enemy, for every victory gained, you will also suffer a defeat. If you know neither the enemy nor yourself, you will succumb in every battle. So basically, there's plenty of traders out there who technically are they're absolutely great at the technical analysis side of it, but because they have got, they've got no risk management, they just haven't really, they don't believe in themselves, as Dax was saying earlier on. They just seem to never get anywhere in trading. So it's really important to have that self-confidence and sort of be aware of yourself and what you can work on. As I've said, so plenty of times my ideas have been correct, but I've been too emotional and ended up counter trading my own bias, resulting in being stopped out. And the worst one is when you've got a bias and you're sure it's going to go a certain way. You might get stopped out a couple of times and you think, you deviate away from your rules and you go, fuck it, I'll go with the flow and I'll open a trade the opposite way. And then next minute it's running off the other direction and you're pissed off with yourself, really. So being stoic in trading. So stoic is a person who endure pain or hardship without showing their feelings or complaining. So this ties in with having no ego associated with our trading. And I'm not talking about the banner you might have on Discord or crypto Twitter, but when it comes down to you alone in front of your computer hunting for entries, you need to have that clear mind, no emotions, no ego, not trying to buy the absolute bottoms to prove how good you are, even to yourself, but just compose, calm, clarity to your analysis and rules. When you achieve the ability to cut out all the noise from others speculating and observe what the charts are telling you and execute on that, you'll become successful. All right, so this is going into the visual psychology. And so what this is basically, I'll get into it. So something I want to touch on that helped me out when I first started, and that was the colors we chose to chart with. It might sound like an aesthetic more than an edge, but let's dive into this a bit. So there's lots of these color palettes out there based from psychologists that explain things, and you've got certain stuff like energy and excitement, action, and that's, you know, these red candles we get. But with green, you get like that psychology of hope, and I'll go further into this with these colors in the next slide. But generally, this is what your charts will look like when they come out of the box. Basically, trading view, exchanges. They've got those green up candles, those red down candles. And let's talk about the visual psychology of that. So the problem is what we have been programmed our whole life to see. So if we buy green and sell red, we're chasing price. So the whole, you know, don't walk, it's red, walk, it's green. Buy, sell. We always see these things. Red is panic, you know, the stop the button, the panic button. So when people have been always conditioned to see, you know, green meaning I can go now, they see green candles, it's spooled all the way up to the top of a range, I better buy now. It's running right down, it's getting deeper and deeper, and it's red, and it's psychologically thinking, oh shit, I've got to sell. Well, this is actually the wrong way around. So this is actually more of a useful chart, which might be a bit funny to you. But basically, it's red candles up and green candles down. So at the bottom of the range, when you're seeing the green there, that means buy. When you're at the top of the range, when you're seeing those red candles, that means sell. But that can be confusing. So we like to just visually change them a little bit. So in this color scheme chosen, blue is calming, it's relaxing. So as the candles are spooling, if you haven't got into a trade yet, you're not going to be so impulsive on jumping in and pressing that market button and ending up underwater. Instead, you're going to stay calm, you're going to stick to your rules, stick to your strategies. And if you do believe that the trade is going to go higher and you haven't missed it, you just wait patiently for it to come back down and get into one of those optimal those trade entries based on those strategies that you guys are all going to start building. And for the down candles here, I've just chosen white, which is just neutral. It's no fear, it's not red, it's not scary, just white candles coming down. So in doing this for these two colors, now you can just focus on the actual market structure. It's easy to be bullish when the candles are green and bearish when they are red, but if you take a step back and break things down logically, you can take emotions out of trading. Price at support, I will buy now. Price at resistance, I will sell now. Eliminating these hardwired reflexes will give you a good running start to trading the market structure over the emotional impulses we've inherited from our lives. And you can also make charts look sexy. So let's have a quick run through on TradingView on how to actually change your colors now for anyone who's actually interested in doing this. So just got a chart set up here. So a few ways you can get into the settings to change these. Most simple way, if your charts aren't too cluttered, is just double click on the candles and it will load up into this section here. I believe in other ways you can, where is it? I know you can click up here, go to your settings there, and another way is just right clicking and going to your settings. So that's the three ways you can get to this section here. So I've just currently got I've got a template on. Once you've created a template, you can just go to save as. But for now, we'll create one. So if I apply the defaults, you normally see something coming in looking like this. We jump in there, we can just start going through some things now. So you can jump through here and have a look at some of these things as well, whether you want them on or off. On someone who does that, I'll sort of go through and I toggle things on and off. Like I don't like these vertical grid lines. So I just come in, click on them, and I'll just completely remove the opacity. And that gives me something nice to play with straight away. You can have one color based on the back of it if you want. Otherwise, you can choose different color. You can make it a gradient or just a solid color. That's what you want to do. Make it something like that for now. And going back to the symbols, so we got the body, the borders, and the width. It's pretty self-explanatory, but if we were just to change these to blue, you can go through there now. Change them to blue. And we can change the red candles to white. Something I like to do as well, something I've recently started doing. There's different types of candles. You can choose hollow candles, but instead of using one candle hollow, TradingView allows you to add this opacity. So I always just drop the opacity down just a little bit. And one of the reasons I've been doing that is there'll be times that you have say you've got some lines up on the chart. You want to chuck a line through somewhere. When you do that, it's not going to show up through there. I'm going to have enough opacity to it. And you can slightly see the line through there. So it's something trivial, but I've just been adding this little bit of opacity into these, and that way I can actually see that line all the way through. And for me, psychologically, it's just giving me a little bit more of an edge when I'm finding exactly where it's touching and what bodies it's going through. And it just helps me sort of define that line a little bit more. Any other questions while I'm in trading view? Pretty good.
Nah, it's really nice, man. I didn't I've never done that trick actually, mate, the candle bodies.
Yeah, mate. So you can just go through and you can bring them right down. So you can almost make a hollow candle if you want. But yeah, it's just a way to have, you're going to put a block through or something, whatever you want to do. Yeah, you're just going to be able to actually see right through those candles where they are, which is pretty cool.
Yeah, it looks better too. Critty said, I didn't even know candles were in front of lines. You can actually change it. Do you want to show them how
What's up?
You can change where the lines, like the levels. Like if you like on Photoshop, you can change if the candles are in front or like move like lines.
Yeah, sure. So it's got a layered system. So say you had a line through here and say you want that line in front or you want the behind, you can click on it, right click and go visual order and you can bring it to the front. So especially if you've got like a bunch of TA and it's getting over the top and you're trying to click and there's say you've got like a box over the top of it and that might be all right with that. But there'll just be times where it's like, oh, I want to get the line underneath. Where's the red line gone? You can right click and just visual order and send it backwards. And then the red line reappears again. And something I do want to go through and create a pretty in-depth, because I've had a request for it, a pretty in-depth overall of trading view. And I'm not sure if a lot of you know, but you've actually got this little icon down the bottom right here. And what that does, Bitcoin's a little pump. You open up an object tree up here. So if you have, just like, just a bunch of words and scribbles and stuff all over there, you can actually go through here after. You can remove certain things, and other things you can do as well is you can lock certain things, or you can highlight them all, shift, grab all of them. And then from there, you can go create a group of drawings, and then you can actually give it a title as well. So, and then from there, you can lock it, remove it. So it's really good if you're just saying, oh, I only want order blocks. I only want, sort of key levels and stuff. Your chart's getting a bit messy. Sometimes I'll go when I actually do a top down and I actually do all of my levels and whatnot. So when I do all my levels, I'll actually put them in a group, lock them, and then because I'll be coming in and trading right down on the 5 and 1 minute, you'll start having like, lines and stuff going all over the place. It's just easy for me the next day to go, all right, well, nothing was important. I can go through here. I can just grab hold of all of them. I can delete them all at once, and then I can keep my key levels. And that way I'm not every morning waking up and either having to create a new chart or having to try and go through and manually delete everything around the levels that I actually want to keep. But yeah, so that's pretty much that. Did you want to take the summary of it?
Yeah, run us through.
Yeah, sweet. So in summary, from psychology, you are what you think. Follow your rules and trading plan. Treat your trading like an important job someone will audit. Discipline yourself with a demon finder. Believe in yourself and your abilities. Know your personality type to customize your rules and trade plan. Be stoic, especially when the markets are full of tense emotions. No ego, no emotions, no noise, just trade the charts. Bring a custom color palette to your charts to remove the go green, stop sell behavior. And just a bit of a quote from Gandhi. Your belief becomes your thoughts become your words become your actions become your habits become your values become your destiny. So just, the power of the mind, hey? But yeah, Dax, what did you want them to do for homework?
So the homework is starting to track their thoughts, so the metacognition stuff.
Yep.
So yeah, track their thoughts 3 times per day. Just take 5 minutes, start to write them down, write down any negative thoughts, and then you reaffirm the positive challenge to that negative thought on the other side of the pad.
Beautiful.
Too easy, guys. And then, have a play around with some of the macroeconomic stuff that we had a look at, and pay attention to CPI tonight.
Sounds good. Awesome. Cheers, guys.
That's pretty much it. Thanks a lot for tuning in, guys. We appreciate everyone coming online to listen to us ramble on. And yeah, you're going to be hearing more from Romps over the rest of the course as well over the next couple of sessions. We will see you guys all on Sunday at 3:30 p.m. For the Sunday afternoon session.
Awesome.
So yeah, thanks a lot for tuning in, lads, and we'll see you all in the next session.
Catch you then, guys.
Too easy. Brody, we'll try and help you get into the Discord. Okay, no worries. Thanks a lot, guys. Thanks for tuning in. We'll see you all in the next session.